Well, did Powell just kick off an early Santa Claus rally? His dovish tone signaling rate hikes could indeed be done, and today's week manufacturing data not giving him a reason to change that. The market now sees a 59% chance of the first rate cut coming in March. But my next guest says if you're looking to get into this market, don't expect a straight line up from here. Joining me now is Mark Avallone, president of Potomac Wealth Advisors. Mark, it's good to have you. I don't know if you've had a chance to look through the Powell comments or the reaction to them, but they are off to the races with this.
They are, and I think the investors are hearing what they want to hear because he gave a little bit of both. But I also read that he said don't expect rate hikes anytime soon. And I think after we had a Fed that was clearly too accommodative for well over a decade, to then have to fight with both hands very aggressively to bring inflation down, and then to expect in just a few months later they reverse course. The only way we see them doing that is if we have really bad economic news. So that is not a good ingredient for investors either. Our base case is they don't move. We're level for longer. And that could continue a slow growth, which isn't always bad for stocks.
Yeah, I mean, I think the way to put this fairly is it's not Powell who's signaling rate cuts. It's the market going, we've watched this movie before and we know we know what happens. We know how this plays out. I think there's typically 7 months, is it, from the last hike to the first cut, something like that. So they're basically just saying, yeah, we're expecting that the tone's going to shift materially in the next couple months. What I find interesting about that is the bullishness of investors and economists even, because you don't start cutting, maybe in this case if inflation falls, but you really don't start cutting until the data gets a lot worse.
That's right. And with a forward multiple at between 19 and 20 right now, you need a lot of earnings growth to justify the future value that investors are bidding up for stocks. And yet in the same breath, we're saying we're bullish on stocks because rates are going to drop. The Fed is going to ease. I don't think you can have it both ways. I do think we're going to get a bit of a straddle. I think we're going to play it down the middle. I don't think we go into a deep recession, which will prohibit the Fed from needing to lower rates. But I don't think it's going to be a robust game on that's going to justify an unabashed move up in stocks from an earnings expansion.
Yeah, one thing that people will have to ponder for 2024 is what to do on the bond side of this. We could show the 10-year, which isn't even as dramatic as, for instance, the 2-year today. The 2-year's dropped like a rock just in the last 6 weeks or so. How does that change, you think, the relative attraction of stocks, or what people might be doing? Maybe they still find these bond levels attractive if they're, better than what you'd normally get in a slowing economy.
Well, the drop in money market rates is going to be bullish for investable assets. That usually will be the case because investors need a place to go. I know I'm trying to wrestle a lot of money out of money markets, and people are just still too skeptical. There's a big pile of money there, and when it does, it will be bullish for stocks. For balanced investors who do have that bond portion, they're going to be benefiting. They're going to look at mid or even high mid-single-digit returns. And against an uncertain backdrop in equities, if you're finding your true risk profile, bonds, talking about high-grade corporates, maybe even some treasuries, you get a tax break in there. But bonds can give balanced investors at least a fight to get to an overall market return, whereas as we saw in 2022, it got hit. I think looking backwards at the 60-40 is not the way to go. I think the bonds already took their beating. They're going to do a lot better going forward.